Level 1. The analyst. You are 23. You came from 2 years at an investment bank. Equity research, coverage of industrial names, 80-hour weeks, a bonus that felt large until you saw what people in the same building made by doing something adjacent, but fundamentally different. Someone on the buy side called. You listened. Your base salary at the fund is $150,000. Your expected all-in first year is somewhere between $250,000 and $350,000, depending on fund performance and the discretion of a portfolio manager you have not yet learned to read. The fund manages $2.1 billion. It is a long/short equity fund. Concentrated. 20 to 35 positions. The PM has run it for 11 years. His Sharpe ratio is 0.94, which sounds academic until you understand that sustaining it for over a decade is rarer than almost any credential you can put on a resume. There are 6 people in the investment team. The PM, 2 senior analysts, 2 analysts. You. The office is quieter than anything you experienced at the bank. No trading floor noise. No rows of junior bankers performing urgency at one another. Just 6 people reading, thinking, and occasionally saying something out loud that the others absorb without ceremony. You will not understand for several months that the silence is the product. The thinking requires it. Your job is research. Not the sell-side version where you produce a 40-page initiation report to support a rating the banker already decided on. This research exists for one purpose: to produce an edge over the market's current estimate of a company's intrinsic value. If your work doesn't do that, it doesn't matter how thorough it is. You cover 2 names to start: a specialty manufacturer and a regional logistics company. You read every 10K going back 8 years, every earnings transcript, every competitor filing. You build a model that goes out 5 years on 3 scenarios. You talk to a former VP of operations who now consults. You talk to a procurement manager at a company that uses the manufacturer's product. You triangulate channel checks the way you were taught at the bank, but didn't fully understand the purpose of until now. At the bank, the research was a document. Here, it's a position. In month 3, you present your first idea formally. You stand at the head of a small conference table. The PM sits across from you. The 2 senior analysts sit to his left. You walk through the thesis, a misunderstood shift in the company's contract structure that the street is modeling incorrectly. Your variant view implies 28% upside to the consensus price target. The PM asks 3 questions. The first is about customer concentration. You have the answer. The second is about the company's pension liability, which you had not modeled explicitly. You tell him you'll follow up. The third is about timing. What is the catalyst that forces the market to recognize what you're describing? You have a partial answer. He writes something down. The position is not put on. Not that week. 3 weeks later, after you've come back with answers to the questions you couldn't answer in the room, the fund initiates a 1.8% position. The PM tells you nothing about the sizing decision. You learn to watch the portfolio management system to understand what happened. By month 6, you understand that being right about a company is not the same as being right about a trade. A correct fundamental thesis can bleed for 18 months while the market re-rates something else. Timing is not a footnote to the analysis. It is the analysis. Your social life compresses without a formal decision being made. You stop declining invitations. You stop receiving them. Your friends are on different schedules now, and you are inside something they cannot see from where they are. You don't explain it well when you try. You stop trying around month 8. Your first-year bonus is $110,000. The fund returns 7.2% net. You deserved more or less depending on whose accounting you use. You don't argue. You open the next 10K. Level 2. The senior analyst. You are 27. You've changed funds once. The first fund was good. The second fund is better, which is the only reason you left. Not money, not title, but the quality of the thinking in the room. You can feel the difference by the 3rd week of an interview process if you know what to listen for. Your base is $200,000. Total comp in a normal year lands between $500,000 and $900,000. In a strong year above that. The variance is real, and you have learned to live inside it without building your life around the top of the range. You own a sector. Healthcare services. Not just the names, the ecosystem. The reimbursement dynamics. The legislative calendar. The labor cost structure at every subsector level. The relationships between payer mix and EBITDA margin that most generalist analysts model incorrectly because they look at the income statement and not the contract backlog. You know where the bodies are buried in this sector because you have been reading it for 4 years and the bodies do not move. You cover 8 names. You have a view on 40 more that you monitor without formal coverage because your PM wants to know when something in the sector is moving before the sector itself starts moving. You source an idea in February. A behavioral health company trading at a discount to peers because of an acquisition that went poorly 2 years ago and left a leverage hangover that the market is still penalizing. Your analysis says the integration is further along than the street believes. The write-down is already priced in twice over. The deleveraging path is 18 months, and the multiple re-rate that follows is 35 to 45% from current. You spend 6 weeks pressure testing the thesis. You talk to a healthcare attorney who works on payer contracts in 3 of the company's key states. You build a bottoms-up model of the reimbursement exposure. You find the variance between what management guided and what the billing data suggests, and it runs in the company's favor. You present the idea. The PM listens. He asks about short interest. It's elevated. He asks why the smart money on the short side is staying. You walk through the bear case and explain why you think it's stale by 2 quarters. He pushes back on the leverage timeline. You push back on his pushback with a cash flow bridge you built specifically for that question. He gives you a 3% position. That is not a small allocation in a concentrated book. The position works. Over the next 14 months, the stock returns 41%. The fund makes approximately $26 million on it. Your bonus that year is the largest of your career to that point. You do not feel what you expected to feel. You feel the pull toward the next idea because the market is already pricing the thing you found and the edge is gone, and there is always somewhere the edge still exists if you are willing to look hard enough and honestly enough, and without the bias of the last position you just made money on. You are 27, and you have made the fund $26 million, and your name will not appear in any document related to that return. That is the correct arrangement. You understand this. The understanding takes longer than you expected. Level 3. The portfolio manager. First seat. You are 31. The opportunity came from a fund that had just closed a capital raise and wanted to add a sector specialist pod. Healthcare. Your reputation in the sector preceded the conversation. The introductory call was 22 minutes. The term sheet came 9 days later. You now run your own book. $180 million in gross exposure to start, with room to grow if the performance is there in the first 18 months. You have a junior analyst who reports to you. Your payout structure is 20% of net P&L after financing costs and a management fee allocation. In a year where you generate 12% net on your book, your personal economics are meaningful in a way that the senior analyst salary structure never was. The first thing you notice is that the loneliness is different. At every prior level, you were executing inside someone else's framework. The PM's conviction shaped the position sizing. The fund's philosophy shaped the idea generation. Now the framework is yours, which means when it's wrong, the wrongness has your fingerprints on it and no one else's. You hire a data vendor in the 3rd month. Claims data, a feed that gives you earlier visibility into patient volume trends in your subsector than anything the company will report for another 11 weeks. The data costs $140,000 a year. You approve the purchase yourself. The decision takes 4 minutes. The first bad quarter happens in month 7. Your 2 largest positions are correct on fundamentals, but move against you on macro rotation. The sector gets sold because rates move, not because anything you identified was wrong. You lose 4.1% in 6 weeks. The fund's risk team calls. The conversation is professional and direct. They are not asking you to change your view. They are reminding you of your drawdown parameters and asking you to walk through your conviction on each name at current sizing. You walk through each name. Your conviction holds. The positions hold. Over the next 3 months, both names recover and your book finishes the year up 9.4% net. The junior analyst you hired works harder than you did at his level, which means you've hired correctly. You tell him this once, indirectly, by giving him more responsibility than his title suggests he should have. He understands the signal. The good ones always do. You call your college roommate on a Saturday for the first time in 4 months. He asks what you've been up to. You start explaining the healthcare reimbursement thesis and stop yourself midway through the second sentence. He's an architect. He does not need the reimbursement thesis. You say work has been intense. He says, yeah. The call ends at 14 minutes. You stare at your phone for a moment. You open your portfolio management system. The position you've been thinking about for 3 days is still there, waiting for one more data point you'll have by Tuesday. Level 4. The portfolio manager. Established. You are 35. You are no longer the new pod. You have 4 years of audited track record at this fund. Net annualized return of 14.2%. Sharp of 1.1. 2 down quarters in 4 years, both recovered within 2 subsequent quarters. The risk team no longer calls you after a bad week. They call you to understand what you're seeing before the bad week arrives. That shift in the direction of the conversation took 3 years to earn. Your book has grown. $420 million in gross exposure. The fund gave you more capital not because you asked, but because your risk-adjusted returns made the allocation decision obvious. Capital inside a multi-manager fund flows toward what's working with the same indifference the market shows toward everything else. You are working. The capital found you. Your payout on a strong year is between $4 million and $9 million, depending on how much of the gross P&L survives the fee and financing waterfall. You have stopped thinking about the number during the year. Not because it doesn't matter, because the thinking about it interferes with the thinking that produces it. You learned this the hard way in year 2, when you carried a position 3 weeks past, where the data told you to exit because the P&L math on your bonus was affecting your read on the trade. You exited late. You made less than you should have. You have not made that mistake again. You now run 2 analysts and use a quant consultant 2 days a week. The team is small enough that you know every position in the book to the second decimal place without looking at the system. That intimacy with the book is not a personality trait. It is a risk management strategy. You have seen PMs who grew their teams faster than their attention could scale. The book gets away from them in the 3rd standard deviation event because someone who isn't them made a sizing decision they didn't fully interrogate. You have decided that the book will not get away from you. This means the team stays small until you find someone whose judgment you trust at the level of your own. You have not found that person yet. The healthcare sector has changed around you. A legislative shift in Medicaid reimbursement structures that you saw forming 14 months before it became consensus. A wave of consolidation in behavioral health that you positioned for early and rode through 3 earnings cycles. A short thesis on a home health company whose labor cost assumptions were embedded in the model in a way that obscured the true margin structure from anyone reading the filings at the surface level. You found it 6 pages into the footnotes of a 10Q on a Sunday afternoon while your partner slept and your apartment was silent. That short returned 22% in 4 months. The position was 4% of your gross book. Do the math. The business development team at the fund brings an allocator to meet you in October. A sovereign wealth fund out of the Middle East looking to seed a new pod strategy within the fund's umbrella. The allocator is 44, Wharton educated, and has been doing this for 19 years. He sits across from you in the small conference room and asks about your process. Not your returns. Your process. You talk for 40 minutes. You do not use a single slide. He asks 4 questions. You answer 3 with precision, and 1 with a degree of uncertainty that you name explicitly rather than paper over. He leaves. The fund tells you 2 weeks later that $300 million of new capital has been earmarked for your pod contingent on an expanded mandate and a new fee arrangement. You spend a week reviewing the term sheet with your lawyer. The term sheet is favorable. You sign it on a Thursday afternoon and go home and eat dinner with your partner and do not mention it until after the dishes are cleared. Your partner asks how your day was. You say busy. This is the most honest answer available. The relationship has survived 4 years of this version of you. The version that is present physically and somewhere else cognitively. That survival has required more from your partner than from you, and you know this, and the knowing does not fix it. You have had the conversation twice about what changes when the fund matures, when the book runs itself more cleanly, when you have more bandwidth for the life that exists outside the book. The conversation is always honest and always insufficient. The bandwidth does not appear on the schedule. It appears only when something forces it to, which is never the right forcing function. Your father calls on a Tuesday. He wants to know if you are coming home for the holidays. You look at the earnings calendar for December. 3 names report in the 3 days surrounding the date he's asking about. You tell him you'll figure it out. You have been figuring it out for 4 years. He says okay, in the way that people say okay when they know what the answer already is. Level 5. The Senior Portfolio Manager and Capital Allocator. You are 40. The fund offered you a role that sits above your pod. Not above it in the sense of managing it. Above it in the sense of overseeing a cluster of pods within the healthcare and life sciences vertical. For pods, combined gross exposure of $1.4 billion. Your job is no longer exclusively to generate alpha from your own book. It is to allocate internal capital across the 4 pods, evaluate the pod PM's performance and risk discipline, and build the vertical strategy as a unified capability within the fund. You kept a small personal book, $120 million. Enough to stay current. Enough that the market doesn't become abstract to you the way it does for people who move entirely into management and lose the feel for the thing they're managing. You have watched that happen to people you respect. The transition from practitioner to overseer hollowed something out of them that they did not notice leaving. You are not willing to let that happen without a fight. Your total compensation last year was $11.4 million. The number arrived as a wire on a Tuesday in February, and you registered it for approximately one afternoon. Then the largest pod in your vertical had a rough March, and you spent 3 weeks working alongside that PM to rebuild the risk framework for his book, and the $11.4 million was simply the prior chapter. You now sit in the room where the fund makes its largest structural decisions. Capital allocation across verticals. Risk budget at the fund level. Decisions about which pods to seed, which to grow, and which are quietly approaching a conversation nobody wants to have. You have been on both sides of that conversation now. As the PM being evaluated, and as the person conducting the evaluation. The evaluation side is harder. Not technically. Technically it is straightforward. A PM's returns relative to risk taken, drawdown behavior, factor exposures, hit rate, and sizing discipline produce a picture that is close to objective if you read it honestly. The hard part is the person sitting across from you who built something real and is watching you tell them it isn't enough. You have learned to do this with precision and without cruelty. You have not learned to do it without weight. A PM in your vertical has been underperforming for 6 quarters. Not catastrophically. The kind of underperformance that accumulates quietly and is always 1 quarter away from reversing and never reverses. You have had 4 conversations with him over those 6 quarters. Each one honest. Each one oriented toward fixing the process rather than ending the pod. You gave him the time because you believed in the strategy and because you remembered what it felt like to go through a bad stretch and come out of it. In the 7th quarter, you have the final conversation. The pod closes. The PM shakes your hand. He is 37. He built the pod from nothing and ran it for 4 years, and the strategy was sound, and the execution drifted from the strategy in a way that compounded gradually, and then all at once. He will land somewhere. People who can do this work at all are not permanently without options. You tell him this and you mean it, and it helps neither of you. You fly home that evening. Your partner has made dinner. You sit at the table, and you are present in the way that you are rarely present. Fully, without a position in the back of your mind running a scenario you haven't closed out yet. Your partner notices. Doesn't say anything. Just notices. After dinner, you sit on the couch. Your partner asks what you're thinking about. You say, "A guy I had to let go today. He built something real, and it wasn't enough, and I was the one who told him." Your partner says that sounds hard. You say yes. That's all. That's the whole conversation. And it is the most honest conversation you have had about your work in years, because it has nothing to do with alpha or drawdowns or capital allocation. It has to do with a person. And for 20 minutes on a Tuesday night, the person is the only thing in the room. If you've made it this far, you're exactly who this channel is for. A subscribe takes 2 seconds and helps me keep making these. No pressure. Back to it. Level 6. The Chief Investment Officer. You are 48. You did not plan to become a CIO. You planned to run a great pod for as long as the market would let you and retire with a number that made the sacrifice ratio defensible in retrospect. The CIO role arrived not as an ambition fulfilled, but as a consequence of being the person in the room that other people in the room kept looking at when the answer wasn't obvious. That is how these things actually happen. Not through campaigning. Through accumulated credibility in moments where credibility was the only thing that mattered. The fund manages $18.3 billion. You are responsible for all of it. Not in the sense that you are making every trade. You have not made a trade in your own name in 14 months. You are responsible in the sense that every risk decision made inside this building traces back to a framework you designed, a person you hired, or a capital allocation you approved. The responsibility is total, and the visibility is partial, and that gap between the two is where you live now professionally every single day. You oversee 11 pods across 4 verticals. 61 investment professionals in total. The morning risk report lands in your inbox at 6:47 each day. 43 pages. You read the first 9 and the last 2. The 9 pages in the middle are for the risk team. The first 9 tell you the shape of the fund. The last 2 tell you where the shape is starting to bend in a direction you haven't approved. Your calendar does not belong to you. It belongs to the fund. LP meetings, risk reviews, pod PM one-on-ones, capital committee sessions, prime broker relationship calls, regulatory conversations, and the occasional situation that has no agenda item because the situations that matter most never do. A pod PM calls you directly at 7:15 on a Thursday morning. He is 3 weeks into a position that has moved against him by 6.2%, and the short interest has begun building on the other side in a way that suggests someone else has found what he found, but from the opposite direction. He wants more time. He wants to know if you'll hold the drawdown parameter while he works through it. You ask him 4 questions. How has the thesis changed since initiation? What does the other side know that you might not? What is the position size relative to your highest conviction scenario? And what is the cost of being early versus the cost of being wrong? He answers all 4. The answers are honest and the thesis is intact and the positioning is disciplined. You tell him he has 2 more weeks and the parameters hold. You hang up and sit with the decision for 30 seconds. Then the 7:30 arrives and you move. That is the job. Not the glamour version of the job. The actual version. 1,000 decisions like that one, made at the intersection of incomplete information and real consequences, strung together across a decade until the pattern of them becomes something the industry calls a track record and you call your working life. The fund's net annualized return under your tenure as CIO is 11.8%. The Sharp is 1.04. In the years where the market gave everyone 20%, you gave your LPs 14%, and they were mildly disappointed and renewed anyway because the risk-adjusted number was cleaner than almost anything else in their portfolio. In the years where the market gave everyone minus 18%, you gave your LPs minus 3%, and they called you personally to say thank you and increase their allocation. That asymmetry is the product. That asymmetry took 25 years to build. Your personal net worth is somewhere above $80 million and below $200 million, depending on how you value the GP stake you hold in the fund's management company, which is not liquid and which you have stopped trying to calculate precisely because the calculation changes every quarter and the number is not the point. It stopped being the point around year 12. Before that, you are not sure it was ever entirely the point, but you are also not sure it was never the point. And the honest answer is somewhere in between and not especially interesting to examine at 48. You have 2 children. A daughter who is 19 and finishing her first year at university. A son who is 16 and plays football on weekends and texts you the score because he stopped assuming you would be there somewhere around age 11. You were there less than you should have been. You were there more than some and less than others, and neither comparison helps. The math of presence and absence in a family does not reduce to a benchmark the way a portfolio does. You have tried to apply the same rigor, and the rigor fails because the inputs are not quantifiable and the output is not a number, and the feedback loop runs on a delay of years, sometimes decades. Your daughter called you last spring on the night before her final exams. Not to ask for anything, just to talk. You sat on the phone with her for an hour and 15 minutes and talked about nothing important and everything important the way conversations do when neither person is performing anything for the other. You were present for that call in a way you were not present for most things during the years she was growing up, and you knew it while it was happening, and you let yourself know it rather than redirecting the thought toward the next morning's risk report. That call is the thing from the last 2 years that you think about most. Your wife has built a life that is genuinely her own. A ceramics practice that became a small studio that became a teaching program with a wait list. A network of friendships maintained with intention and consistency that you observed from a distance and admired without fully understanding because you have not maintained a friendship with that kind of intention in 15 years. She does not resent the structure of your life. She understood the structure before she married into it, and she made her choices inside it the same way you made yours, and the two of you have arrived at something that functions and occasionally, on a Saturday morning when neither of you has anywhere to be, is genuinely warm. You are considering what comes next. Not because you are burned out. Burned out implies the fire was supposed to keep burning indefinitely and simply ran out of fuel. This is different. This is a considered question about whether the thing you built still requires you specifically, or whether you have built it well enough that it runs correctly without the original architect present. A good CIO, you have come to believe, should eventually make themselves unnecessary. The test of the system is whether the system holds when the person who designed it walks out of the building. You think the system holds. You are not entirely sure. And the uncertainty is, for the first time in a long time, genuinely interesting rather than threatening.